Hi, this is a webinar from CryptoWorth. I'm Ari, marketing manager of CryptoWorth, and I have here Jason Schwartz and Jozef Vogel. Would you like to start, Jason, by introducing yourself, please?
Yeah, sure. Hi, I'm Jason Schwartz. I'm a tax partner and co-head of digital assets at Fried Frank Harris Schriver and Jacobson, which is an international law firm. We count among our clients financial institutions, centralized exchanges, asset managers, and DeFi protocol builders.
Jozef Vogel. I'm the COO for Ether5, which is liquid restaking protocol. Previously, before that, I was with the Aave companies for a couple of years, focused on both the ops side and then on the digital asset accounting side as well.
So today I just want to, just as an icebreaker, I want to ask you, what excites you the most about Web3, but right now?
What excites me most? I mean, every day I read something new that sort of excites me. But I've really been enjoying going down a rabbit hole into tax considerations relating to DAOs and DAO structuring and various DeFi and also sort of social fi protocols.
Yeah, for me, I think it's like continued real use applications for a lot of the things we're building. I think like to see more and more users come into the ecosystem, and starting to see like the expansion of like a real use case product, whether that's like staking, which is obviously where I'm very focused in, but then building products on top of that that allow users to either spend their digital assets or find other use cases that really kind of keeps them on chain and bridges the gap between real world use cases and their digital wallets. I think like continuation of that, and even if that starts with like payments or whatever it might be, I think a lot of accountants are quite familiar with the ease of paying people in stable coins internationally, cross-border payments, all that stuff. I think those applications, although maybe not the sexiest things at times, are actually like really, really good applications and much easier to use, I find, than the traditional system. So I think it's things like that that kind of keep me very interested and very excited about the space.
Awesome. Okay, thank you. So let's just get into it. Joseph, could you discuss some of the challenges and solutions you've been looking at or working on about applying the standard account thesis to liquid staking?
Yeah, I think the first issue is really like trying to track all transactions on chain. I think like we're starting to see a lot better applications that are able to do this. But I think like that's just the first challenge that everyone kind of gets through is okay, we made 1,000 transactions in a month. All right, now I have to actually try to like jam this into like the framework of an accounting system and try to figure out like how the swaps work, how everything kind of works in the back end. So I think like that's the first like real issue, and like not even taking staking, like not even considering staking in that framework, but then kind of building staking on top of that. It's like now okay, we've deposited ETH. I just was holding ETH. It wasn't earning anything. Now I have this like liquid staking token that has just native yield built into it. So that adds like an additional layer of complexity to just like a rebasing token or a non-rebasing token or just like a basic yield generating token. And we're starting to see that not just with staking, but with other applications as well. You start to see kind of rebasing stables now as well that just have like this built-in yield into them. So I think like that's the next iteration, and how we record that is still it still needs a lot of work. I think to really like pick up on that like constant accrual to the token, and how accountants can record that, and how we can see that on chain. So I would say like that's kind of more of the challenges I seem to find. I think people are now kind of familiar with the swap use cases, how to record those transactions for tax purposes, whatever it might be, depending on the jurisdiction. But the next piece is really like trying to focus on like how do we now accurately record gains on swaps, continued accrual on tokens. It's kind of that realm is the next jump that we have to make, I think.
Do you have something that it's simple or at least the beginning of when you need to value for those, as you say, the rebased yield, something that is basic and that it covers a good beginning to do the rebase evaluation?
Yeah, I think there's a couple ways, and there's rebasing versus non-rebasing tokens. Like if we look at maybe I'll use EtherFi as an example. It's very similar to the way stETH and wrap is created. So stETH being a rebasing token, and then wrap stETH being a non-rebasing, meaning that the quantity doesn't change, but the value of that asset changes over time. as basically there's kind of accrued rewards. Those are based on a share-based mechanism that then accrue to each individual token, I guess, in proportion. I guess taking the increase in value month over month would be like the most simplistic use case. But then again, like to say there's like this clear framework is really kind of oversimplifying things, because as soon as someone then goes and like trades that or puts that in like Aave or whatever it might be, obviously like that kind of goes out the window. Now they have a RAPSTETH, and then things just kind of compound on top of that. So very simplistic level, it would be a change in value month over month. But in practice, obviously, if someone's kind of more familiar with this, it gets a lot more complicated than that.
And I remember from a past conversation we had a few months ago that you said that the staking rewards are often only realized when assets are withdrawn. So the timing of the recognition also changes. Is this related to the month to month you said? And it makes sense that accountants will do month to month because they want to close month end every time?
That might come in, and again, this is probably really related to jurisdiction and what like the tax implications are based on that. For me, I operate in a non-tax jurisdiction, so it's kind of, I guess, simple for me to say. Obviously, kind of more familiar with some of the other use cases, but yeah, I mean, it really does depend. I mean, you can recognize them when you actually withdraw, but in practice, even if you have unrealized gains month over month, you need to be recording those, and you would want to show those somehow in your income statement. Like you need to somehow show, okay, we had a gain on value appreciation in this month. Like even if it's unrealized, you still need to show it somehow, and you just would want to, just for tracking purposes, to see how your positions are doing. So yeah, I guess there's like a couple ways to approach it, but it wouldn't just be like I withdraw now I realize. I think in reality it's probably again a little bit more complicated.
Yeah, I get you. Like Jason, you want to chip in there? I think we gave you the cue on what are the what happens when you do the withdrawal, or what are the tax implications on the unrealized gains, and
Yeah. So obviously there's a lot of uncertainty about the taxation of different liquid staking token transactions. I'll give the TLDR of my own view, and then maybe explain that there are some alternative views, and the rationales for each. So my own personal view is that if you exchange ETH for a non-rebasing token like wrap staked ETH, then that's a taxable exchange that gives rise to gain or loss. But that then subsequently the rewards that are accruing inside of the relevant smart contract are not taxed to you on a current basis. So, what does that mean? Well, if I have ETH that doesn't have a substantial built-in gain, or ideally has a built-in loss, I'd want to and I want to buy an LST. I would choose wrap staked ETH or RETH, Rocket Pool's RETH, which is a similar architecture, because that would enable me to take my capital loss, and then I wouldn't have current accrual of ordinary income as staking rewards come into the protocol. By contrast, my view, and again, my personal view, which doesn't necessarily reflect the view of everyone or even everyone at my firm, is that ETH to STETH, right, to a or another rebasing token is not taxable. But that then, as the rewards come in and are credited to your wallet, you have to include those rewards as ordinary income. So, what does that mean? If I have ETH that I bought, in whatever 2012 or something, and I've been sitting on it, so it has a significant built-in gain, I wouldn't run to recognize that gain, but I could swap into STETH without recognizing a gain, and then just have current ordinary income equal to the reward. Like several theories that support the view that I've described. One is actually just sort of pragmatic, which is that, look, in practice, no one is reporting current rewards accruing inside of a pooled smart contract like RAPSTETH or the Rocket Pool contract. It's really hard for like a retail investor to figure out their share of rewards that are accruing in there, and the tax prep softwares are not doing so. So it sort of makes sense. Again, this is just being pragmatic. It makes sense to say, well, you've got to be taxed on something. So at least, pay tax on your way in and on your way out. Whereas, with a rebasing token like STETH, the IRS is fairly clear that you do have to include those rewards currently that are credited to your wallet as ordinary income. And accordingly, I think it's fair to not recognize gain or loss on the way in or the way out. In terms of the sort of legal analysis, again, there are a few rationales. One is looking at tax code section 1001, which basically says an exchange of property for other property is taxable, but only if the new property is materially different in kind or in extent from the old property, right? So materially different in kind or in extent. As applied to crypto, it's not really clear how to apply that test, but I think it's certainly reasonable to say, look, Steve and other rebasing LSTs are effectively just receipt tokens. They're wrapped ETH. I can exchange, one ETH always equals one Steve. I can always exchange one Steve back for one ETH, and accordingly, one Steve is not materially different in kind or in extent from ETH. Whereas, with a non-rebasing token, one ETH does not always equal one R ETH or one wrapped Steve. So they are materially different. We can sort of go into even more, granular arguments, but maybe I'll stop there to see if either of you has any comments or questions.
No, I mean, I would support that position. I guess I don't know if you said it's kind of your personal opinion, but I think is that kind of like, I guess, been adopted.
Well, I think it's the right answer, obviously.
I would agree. I would agree. It's really substance over like, I think reform, like it's really trying to actually think like what is really happening here, and I think like that's a very practical way to look at it. Has that kind of been the adoption? Like, that been a lot of the ways that people are actually reporting it?
I like to think so. I mean, my as far as I know, my clients do that. But I'm actually aware of at least some accounting firms that take an even more conservative approach and say that
Yeah.
ETH to STEETH is taxable. Frankly, I just think that that's actually maybe counterintuitively to some listeners an aggressive approach. I think it was adopted by some accounting firms with the thinking that it was more conservative because, well, like just increase the number of taxable events people have. But the reason I think it's more aggressive is that in loss years it effectively enables people to recognize losses when they're really swapping into something that is identical property from my perspective, right? It's akin to saying that ETH to wrapped ETH is taxable, and I just think that can't be the answer, because if it were the answer, in every loss year I would just wrap my ETH, and then and I know that economically I still have ETH, but I would recognize a capital loss. I just don't think that that's acceptable, from a policy perspective. Similarly, I think bridging is a non-taxable event. And, if you look at like Blast, which, famously has sort of embedded yield in their bridge contract, what they're doing to generate that embedded yield on ETH, and this is all public documents from their website, is they're taking the ETH that is bridged up to Blast and investing it in Steve. If you thought that ETH to Steve was taxable, that would mean that ETH bridged up to Blast is taxable. I think you end up in like very weird scenarios if you believe that ETH to a rebasing liquid staking token is a taxable event. And then I'll also just point out, since you're sort of asking about like the like more granular stuff. There's also a concept. It's also sort of under tax code section 1001, but it's been further developed. If I were to lend you a security, like a real security, not a crypto asset security, some fictional piece of property that the SEC thinks exists, but like a IBM stock, for example, and you were required to return identical IBM stock to me upon demand, that's explicitly not taxable to me. There's actually a separate tax code section that says so, but the principles of that section, it's section 1058, are grounded in this materially different standard. That namely, an exchange of property for an obligation to return identical property on demand is just not a taxable event, right? So similarly, if I give you ETH and you give me a receipt that basically says like, I'll return your ETH to you on demand, that ought not to be taxable under the same principles. And I think Steve is such a receipt. By contrast, our ETH or wrapped Steve just it's not, right. It represents something else. It represents this accrued yield that's accruing inside of a smart contract. I know economically, like, people think of it as the same thing, but again, one ETH is not one wreath or one wrapped Steve. It
Yeah.
represents like a bundle of other things. So I don't think the same principles apply. There's also an argument that like a pooled smart contract, like the RETH pool or the wrapped seed represents some kind of like deemed tax entity. It's like people that, let's say, the RETH holders are effectively like shareholders in this joint venture. This joint venture is sort of doing stuff, right? It's staking, and it's paying out the stakers and accruing the profits inside. And I think there are like counter arguments to that, but just sort of looking at that concept as an analogy, exchanging property ETH for like corporate shares would be a taxable event. So again, same sort of concept.
Yeah, yeah. Thank you for it. I think although you don't want to go through the granularity, sometimes it gives the perfect example to see how are the different arguments and the different approaches that some professionals are taking. So I think it's very interesting.
Yeah.
Thank you for sharing.
Yeah, and if anyone wants like further reading, I've written on this. It's called the latest DeFi alpha is tax optimized staking, and I wrote it a couple of years ago, but it still reflects my views.
I want to jump to another topic about reconciliation and management, right? And I know that you told as this conversation started that one of the challenges was like getting the data and recognizing the data and to be accurate. So I understand from my point of view that sometimes liquid staking, its nature makes the controller or the professional looking at this that requires manual intervention. What has been your experience there, and do you have any practical measures on how can people do this in order, I would say, waste less time in doing the manual work?
Yeah, I think if you're just staking and that's all you're doing and you're holding, I think it's pretty straightforward. I think at the end of the month, you look at if whether we call it a swap, whether we call it exchange one for one, whether it's a taxable event or not. I think if you're just holding and at the end of the month you were to do a reconciliation, you review all your balances on chain, you kind of calculate any realized gains, losses in there, you just reconcile out to what your ending balances are. I think that practically quite simple now. I think that is kind of more refined. I think like the typical tools out there allow you to do that, and I would recommend that anyone using like a spreadsheet solely kind of goes to some tracking tool that's kind of designed for this purpose. The complexities really come around what you do with those assets after the fact. So if you're wrapping into let's say wrapped ETH, and then you deposit that into a Uniswap pool, now you have like a concentrated liquidity position. You have partly wrapped ETH. Now you have ETH. Now you have like an LP token that you need to track. That's like where the complications really start to come into play.
Mm-hmm.
And I mean, one is that LP token. I mean, do you have a value for that when you receive it? How do you record that? And then how do you record subsequent gains or any kind of LP fee shares or any kind of appreciation on the value of the underlying? That's where it gets really complicated. And I mean, a lot of the times, if you're kind of claiming rewards, like, I mean, if you have some reward claim on all the trading fees that are in the pool for the month, it's good to kind of stay on top of those. And then it's kind of operationally more of a pain because now you have to go to each platform, you have to claim all your fees, and you have to do that on a monthly basis. And sometimes based on gas fees, it doesn't make sense. So really trying to like figure out what method works best for whoever's trying to record those. Let's say you claim, now you have the fees come in. So that's, I mean, you can recognize that as income. You can kind of recognize that however you kind of see fit. But then recognizing now like the change on the LP token is a little bit more difficult because you have to look at your underlying position. And a lot of times you can kind of work your way into that and see like what the appreciation is. Again, that would kind of be your unrealized gain. So to do that on every single position is very difficult. So it's not something I necessarily do on a monthly basis. It's something I'd maybe do at year end if I was still holding. Because a lot of the time, I mean, if you swap out or if you need to kind of reposition your concentrated liquidity, that's going to be like a taxable event. So you'll realize it at some point if you reposition. So yeah, I guess that's one example, but yeah, sometimes not. I really try to just like for simplicity's sake, just try to do whatever. Let's say if I put in half ETH, half RAPS ETH, the value of the consideration given is what I mark the value of whatever was received, so the LP token, and then vice versa also holds true. So assuming that you have that LP token supported and that you recorded it correctly, ideally, when you then go to swap out, you would have the ability to track that gain loss on your position over time. But again, sometimes you can get like a different allocation mix back. So let's say we did 50-50 RAPS ETH. Now over time, my position has changed. So now I'm getting maybe 70% RAPS ETH, 30% ETH back. So then if we're talking about the underlying tax implications of how we treat those two assets, it again adds more complexity. So, I mean, all that to say, I think there's just like, you really have to understand at a pretty deep level once you start doing those type of trades, how everything is being recorded. So I would almost recommend like that's the first level is if you're trying to track a position, make sure you really understand what's happening in reality and then try to figure out what the best approach is for you. Because I think it depends who you ask. A lot of people can take a different position, but I always find like if you really understand it and you really feel like this is how it should be recorded, I mean, back your opinion, ensure you kind of have like sufficient support to do so. But I would kind of encourage people to put forward their thoughts on it and really try to take like an opinion on what they think is best based on like the actual form of what's happening. So
Yeah, I would just want to echo that. I mean, on tax law, you know, U.S. tax law is really a substance over form
yeah,
discipline to a great extent. So I think one of the troubles that a lot of people have is that they're going to tax lawyers who don't understand the technology. And that like creates problems. And you know, I mean, the best thing to do in the absence of guidance, in my view, is come up with a reasonable position based on what the substance of the transaction is, and apply it consistently across all your transactions. Right? Yeah. I just wanted to note on liquidity provision, just you know, sort of similar to liquid staking. I think it's really an uncertain area. And I hate having to say this over and over again, but it's true in crypto. I would say that for like a Uniswap V2 type, you know, architecture, you know, Sushi Swap, sort of the older type, you know, of architecture, non-concentrated liquidity. I think they're similar to, you know, the like ETH to RAPS ETH argument. There's a really good position that like entry and exit is taxed and you don't accrue, you know, whatever's going on inside of the token, inside of the pool on a current basis. You know, not only is it like sort of, does it make sense practically? I think there's legal, you know, good sort of like legal principled arguments. And for what it's worth, since 2014, we've had IRS guidance saying that virtual currency, which is basically like any fungible tokens, are property, and doesn't say look through property. It doesn't say like disregarded property. It says property. So like ETH, you know, some LP token that is like fungible with a lot of other LP tokens, you know, I think you have a good position that that's a taxable exchange of property for different property, right? Materially different property. With a V3, a Uniswap V3 token, it's a little harder, right? Because you have a position that might really be unique to you. It's, you know, and if the position really is unique to you, you're sort of potentially outside of that 2014 guidance. Like you don't really have virtual currency. It's not fungible.
it's
Is
not
there,
pooled.
yeah, is there a potential argument that you're really, you know, or I shouldn't say potential, a stronger argument that you're really just like using software to conduct these transactions directly, so that you really should be looking through to like all the trades going on underneath and you're deemed to be doing all of those trades? I don't know. I mean, that's certainly not very administrable. So, I think people are just saying, well, like any liquidity provision is taxable, but I don't, I think it gets harder in, when the liquidity provision is like concentrated liquidity and like you have the ability to, set your own fee, etc.
Huh. Yeah, interesting point. Yeah, for sure. I mean, I would agree. Actually, thinking about it now. Yeah. Okay. Yeah, I mean, it adds complexity, and now you're like, yeah. I
I
think
don't know.
that's
I don't have a
probably.
good answer.
Yeah. I mean, I don't either. But that's something to think about for sure. I'm actually gonna kind of work through that practically and see.
I was thinking with all of this complexity that you described well, I imagine like the professional having to at least to account for this, or even like for accountants who are working with clients doing this and they just receive everything they've done. I'm sure it's like daunting. Any advice you could give? Like now we're talking about people that they didn't have the chance to be at the moment of the transaction to make a note, so they're looking at the history of the wallet. How do I make a call to minimize errors and
Look, again, I don't even know that there's well, I shouldn't say that there's no such thing as an error. There are definitely positions you can take that are just objectively unreasonable, wrong, But then there's a really wide range, I think, of positions you take that are reasonable, even though they might be inconsistent with each other. For example, liquidity provision, maybe it's taxable, maybe it's not, maybe sometimes it is, and then in some situations it's not. Again, I think the key really is to, again, like come up with an analysis and apply it consistently. Consistently, by the way, again, doesn't mean that all liquidity provision is taxable or all liquidity provision is not. You can have you can have a theory whereby a liquidity provision, as I sort of said, so like a V2 type architecture is taxable, but liquidity provision to a V3 type architecture is not. And I think there are good reason, potentially good reasons for that. But really, just be consistent. At least my personal experience with the IRS has been that they're fairly reasonable, right? Particularly when there's like no guidance, no clear guidance. They're not gonna stomach inconsistent positions. So taxpayers are largely left to fend for themselves in this space. But like let's kind of be responsible adults about it.
Yeah, I mean that makes a lot of sense to me. I don't know. I would second that too. I think like going through audits and like I've kind of been through one on the tax front, and like I guess just really having like the appropriate support and being able to really like back your decision like really does help. And I think I've seen a lot of either auditors or tax professionals when they're reviewing be quite reasonable to that approach, just as long as it is consistent across and you're not saying, hey, for this one I do this, but like here this is kind of a little bit more beneficial. Like exactly, just be very professional about it and take the right approach, and just like really know what you're kind of really understand thoroughly what you're talking about. And I think it helps too to just like educate a lot of these like auditors or whoever it might be, kind of reviewing these records. Because I just think the more people that can kind of form a strong opinion and then pass that along and really try to help feed that down, I think is just like crucial as the space kind of continues to evolve. So yeah, like really grateful for people in the space who kind of take that extra time and effort to really build these like, good thought pieces on stuff.
Yeah. Yeah. I would also say to some extent, we're making the law, right? I mean, oftentimes, and I saw this happen in the TradFi space. I'm a financial products tax attorney by training, and there are a lot of uncertainties in the taxation of financial products, but we come up with reasonable positions and we apply them consistently, and they effectively, in the absence of like contrary guidance, become the law, right? Sometimes people refer to this, in maybe like a jaded way as the Wall Street rule. But the Wall Street rule like makes a lot of sense when, when it's not like whipsawing the government, and it's also, an acceptable position from a policy perspective, right? From like a tax administration perspective. So like I mean, one of my goals in putting out thought leadership pieces and speaking and like, panels and whatnot, is to sort of advocate for approaches that I think make sense, right? And, if everyone adopts these approaches, like you're not going to avoid tax, but like you're going to have sort of a, like a reasonable position that hopefully has you paying like, an acceptable amount of tax, right? The right amount of tax. And you're not like screwing the IRS. You're not whipsawing the government in some unacceptable way.
Yeah, thank you for that. I have two more questions. The first for Joseph and the last one for both of you. I just want to understand if currently accounting standard can be linked to how you account for liquid staking tokens.
Yeah, I think some have come to like conclusions on what standards they think are best suited. But I guess I'm going to kind of shy away from it a little bit because I think this is very jurisdiction based. And I think there's a few different ways, but I would say like really just I don't know. I see some people trying to kind of force it into certain frameworks that exist, and maybe it's like a maybe you can back your way into okay, these have some similarities, but my experience is really trying to like we've kind of been talking about, bring some new approaches to this, and I would kind of encourage to not necessarily just try to like break into like some rigid framework that already exists. Obviously, we do have to like operate within like the existing kind of standards that are put forth, but I think there are some kind of novel approaches to really like carve out what is unique about digital assets and how they're recorded, and like the gains that are accrued on them, and whatever that may be. And it's again not trying to dodge tax or like kind of whipsaw around. It's really just trying to like actually record them how they should be, and not just like deeming them as like this intangible property or whatever it might be just because like oh we have this framework so let's try to fit in there. I really think like just creating like a good thought piece or like a good memo is what my like old accounting standard kind of pushes me to do, is just like to write a good piece as to like why I think this is how it should be recorded, and to really back that up with like clear examples. And I guess yeah, without like saying any specific standards, that's like really my opinion on it.
Okay, thank you. So the last one, we were talking about when accountants, controllers, and professionals are trying to go through all of this complexity, and sometimes they can do it with any tool available. If they have like a few dozen transactions, they can take the time to do it in a spreadsheet. But we know like when you have 1,000 transactions in a month with this level of complexity, it gets a little bit difficult. And there are tools out there that help you go through this. And I wanted to ask both of you, which criteria should professionals in organization use to select these tools? What should they look at when they have to choose one of these tools that will allow them to manage of the tax side of it and the accounting side of it?
Yeah, I mean, from my side, it depends. Like, I use a lot of different assets. So for me, it's important to have like a an accounting software that can track both across the cross chain. So like Base, we mentioned Blast. I mean, that list goes on. So ensuring both I can track asset not just on mainnet, but then like a tool that can support all the ongoing assets that are going to be added as well. For me, I like working with good teams. I like working with projects that continue to kind of iterate in this space because it moves so fast. So having kind of a platform that's not really keeping up to like what's going on is just makes it very difficult. So yeah, I think that's like one of the bigger things. And then also like having something that can kind of reconcile and has like a good ability to see like all your month end positions by wallet, reconcile those back to all the transactions, making sure like data completeness is always there. I think it like is a really good tool just to really like support your positions, making sure that you kind of reconcile everything out. And again, that's not easy. So a tool that does that is like really going to help you when you need to support any kind of movements and back that into like what your current digital asset position is.
So yeah, I mean, I agree with that. I guess there are different types of taxpayers. Obviously, one is like your sort of retail taxpayer that does like a few trades every year, or maybe a few thousand trades. I don't know. In crypto, we're all kind of degens, but relatively like small amounts, right? And I think they're most of the tax prep softwares are have pluses and minuses. None of them are perfect. Find one that you're like comfortable using for your use case, use it, and try to use it consistently. Just like a word of warning, many of these softwares allow you to specify like different types of tax accounting, like not just first in first out, but like highest in first out and like last in first out. Those are actually not technically permitted forms of accounting. Technically, it's either first in first out by default, or you have to specifically identify, meaning that you're supposed to have a contemporaneous record of which lot you are intending to sell when you make a sale. So just like be maybe when choosing which accounting method to use there, just sort of like do a little bit of research as to whether you're actually eligible to use those methods. But that's sort of an aside. For like larger clients, or I should say clients with more money at stake, they're typically going to use a tax return preparer, right? Like an accounting firm. And there I would say really try to find a crypto native accountant. And different people might have different ideas of what crypto native means, but like there are ways to tell, right? Like ask them if they've ever done an on-chain transaction. Ask them, what their view is on how, LSTs, ETH and LST or is treated for tax purposes, and see if they give like a somewhat like educated sounding response. I think a lot of people get burned using accountants that claim to have crypto expertise and really don't. So that would be my word of advice. I know we're at the very end, but I just want to also note we've been talking about staking this whole time. There is a view among some tax lawyers that like consensus layer staking, like rather than buying LSTs, but like actual staking rewards are either not taxable or not taxable in part, right? To the extent that the staking rewards constitute newly minted tokens, right? And then on Ethereum, I don't remember what it's something like 60% of the rewards approximately are newly minted tokens. The rest are like priority gas fees. On Solana, like virtually all the rewards are newly minted tokens, and on other chains, you have different variety. What that means for LSTs, one, the IRS disagrees with that, so just be aware that like you can take that position. I happen to think it's a reasonable position, but the IRS explicitly disagrees with it. So you would be going counter to the IRS's views. But what it also means for LSTs, is an open question, right? Like if I buy Steve and I earn current stream of Steve rewards, like is a portion of those rewards non-taxable if I'm taking the position that the underlying activity gives rise to non-taxable yield? I don't have a good answer, but it's worth just as a footnote considering that if that's sort of after considering the risk of taking a position that's contrary to the IRS's views, whether what that means for LSTs, and also something to ask your accountant if you're if that's something you're interested in doing.
Sure. Good point. Okay, thank you very much, guys, for this conversation. Just if you could like to share how to be contacted in the future by the listeners and the viewers of this, if they have any further questions or intriguing things that we've discovered and we didn't go through, could you tell us how to get in touch with you?
Yeah. So as I mentioned, I'm Jason Schwartz and I'm at Fried Frank. If you Google Jason Schwartz Fried Frank, my professional bio will pop up. I'm also Crypto Tax Guy ETH Twitter, Crypto Tax Guy on Farcaster, Crypto Tax Guy on LinkedIn. So fairly easy to find.
Yeah, I mean, I guess I'm not necessarily like a service provider, so I follow like EtherFi on Twitter as well. But yeah, I would just kind of encourage. I would say Crypto Tax Guy is probably a good outreach source to really stay up to date.
Yeah, but a warning: I'm not an accountant. I'm a tax lawyer and I don't do tax return preparation. So I consider, the the tax treatment of various transactions under the law, and I can advise on that. Feel free to try to reach out to me, and I'll try to answer if it's easy enough on Twitter or something. But you probably want an accountant.
Thank you, guys. Have a good one.
Thank you. Take
All right.
care.
Thank you.